Hey guys, what's up? On this episode, this was kind of a one podcast for two podcast channels episode. I was actually a guest on my CPA Marcus Crigler's podcast called Strength in Numbers, and I thought it was a relevant enough conversation to bring it to you guys as well, to also put on the Real Estate Fast Pass podcast. So this episode is really directed towards real estate professionals are those people who qualify as real estate professionals. And now, if you don't qualify as a real estate professional, you might want to stick around so that you know the reward for being a real estate professional and that it is worth going through the work that you need to do that. So here's the intro for this podcast. So if you've ever felt, and I'm speaking really to real estate professionals, if you ever feel like you're crushing it on income, flipping deals, wholesaling, and you're just stacking checks from deals, but then come tax season, the IRS keeps taking a bigger and bigger bite than you expected, and you still don't have a portfolio of rentals to show for it, it's a common trap. We all start out focused on the hustle, but while we're hustling, we sometimes forget to think about the long game. And now think about this. What if you could fix your tax problem and build wealth at the same time with the same money, without derailing your core business? You're listening to the Real Estate Fast Pass podcast, the shortcut to smart investing and long-lasting wealth. I'm Jimmy Vreeland, real estate investor, business builder, and your host. Today, we're asking a big question. How do high-earning investors finally get serious about building wealth through real estate, but without slowing down their deal-making machine? And to do that, with me today is my accountant, my CPA, a guy who has guided me through a lot in this industry, Marcus Crigler. He's been in my corner for years, and he really taught me the tax and the accounting game. And he helped me get very smart on my tax strategy. And he also helped me with my liquidity and my long-term wealth. And Marcus has worked with hundreds of top-tier real estate professionals, mostly inside the collective genius. And he knows why exactly so many of us hit a wall when it comes to buying real estate the right way and saving on taxes the right way. So in this episode, here's what you're going to take away. The truth why most investors screw up cash flow and how to avoid it. How bonus depreciation and cost segregation legally destroy your tax bill. And the exact type of rentals that I'm buying today. And why I'm calling BS on the 1% rule. Plus, you're even going to hear the story of when I owed the IRS $250,000 and I just did not have the money. And that crisis almost broke me. But Marcus helped me back in the day, laid out a complete plan that saved me from the IRS.
Hey, Jimmy, what's going on, man? Welcome to the Strength in Numbers podcast. How are you doing today?
Hi, Marcus. Great to talk to you.
Man, it's always a pleasure. It's always a pleasure on a Friday. I don't know when this is going to be released. I think you're going to release it on a Monday, but it's always a pleasure on a Friday to get to talk real estate with Jimmy Vreeland. I will say that because here's the thing. One of the things that I always appreciate about having a conversation about you is you challenge the norm when it comes to real estate. And I think, you do a lot of things that a lot of people do, but I think you do things slightly differently. And I think how you believe in things in real estate is slightly different. So I'm really excited to talk about some of those things today and see where this podcast takes us. Let's go backwards just a second. So, I think it's important that the listener knows kind of what you've been through and what you've gone through to get to where you're at today. So, if you don't mind, I'm going to speak for you in just this one thing. And this one thing is this. I've been able to have the opportunity to watch Jimmy grow his business over the last, let's say, 5 years or so. And the place that he's at today versus where he was at in the past is so much different as far as the level of success that he's been able to achieve. And I think so much of that is through this process that he's been able to kind of go through and get to where he's at today. So Jimmy, kind of walk us through some of this process of, how you figured it out to where, hey, today in a market that's maybe as tough as any that we've seen in a long time, you're still able to see a lot of success.
I'm going to do the Reader's Digest fast version, but at the end of the day, I've done everything in real estate completely backwards. And so I do have somewhat of a contrarian view because of that, because I think I've seen outside the box. But the short and fast of it is I started buying real estate when I was deployed in Iraq in 2006. I read Rich Dad Poor Dad. I was like, I'm going to buy a bunch of rentals. My cash flow will be greater than my expenses, and then I'll be rich. And Jordan Peterson always says it's better to be walking using the wrong map than not walking at all. And so I love Kiyosaki, love that book, but I think anybody in the game thinks the whole cash flow greater than expenses is a bunch of shenanigans. But it got me moving, it got me going, helped me build a ton of wealth. And so he's not wrong. It's a matter of timing. So got out of the Army. Next thing Rich Dad Poor Dad says to do is get a sales job. My brother was in medical school. When you're leaving the Army, a bunch of people recruit junior military officers out of the Army. They're like, hey, your brother's in medical school. You want to sell things. You want to sell medical sales? I was like, sure. I'm like, my brother will teach me everything I need to know about the anatomy side, and then I'll just go sell. And so I kept buying 2 rentals a year through my corporate sales years, but I kept wanting to, do this full time because I loved it. And eventually, after buying 2 houses a year for around 10 years and 8 years in corporate sales, I was able to jump and to pivot. And like my last 2 years in corporate, I bought 60 houses. And so I had enough debt. I used my sales skills to learn how to raise private money, but I had enough debt, got up to 100 houses to just put myself in a very dangerous and precarious position that I thought was financial independence. But it turned out I was like the worst financially I could have possibly been. And thank God for the collective genius and Jason Medley for showing me the errors of my ways.
Yeah. So you say you did it backwards, but one of the things that you did right was that you had a paycheck, right? You were making consistent money. You didn't, go buy a couple rentals and then just get rid of your day job and then start into real estate, right?
Like Trang goes to me when I was on his podcast. He's like, huh, what? Why didn't you just leave the Army and start wholesaling? And the answer was, I didn't know it existed. That was the short, dirty of it. But I also don't think I would have done that. I needed to spend some time seeing how the real world operated coming out of the Army. And I also bring that up. So then go to CG. I'm like, I have 100 poorly managed lease option rentals and I think I'm rich. I'm actually just in debt and poor. And then Jason's like, dude, you got to find some active income. Luckily, turns out there were a bunch of investors who wanted my rentals. So I started selling off those rentals. To sell the rentals, I had to start managing properties. Started managing properties. Then I ran out of inventory. And this is like 18, 19. So you could still buy 100 houses off the MLS a year. But then in 20, when the market exploded, the MLS died. So then I had to learn wholesaling and go in direct to seller. So I bring that up just saying wholesaling is the microwave part of my organization right now, but it's the youngest part of the organization and it's what most people start in. So I did it last and backwards.
Yeah. Yeah. And I think it is a funny story because, generally people start with wholesaling, then they'll keep a couple of those pieces of real estate and then, they'll try and find as many exit strategies as they can, maybe turnkey being one of them. So from that standpoint, I think it's an interesting shift. Why do you think, do you think there's any advantage you had to doing it backwards this way? Or do you think it's just happenstance that it just worked out this way?
No, I think I'm very grateful for doing it backwards. Because I've had a set of I buy and sell a lot of them, but I've had a wealth foundation of 50 to 60 rentals that I've been able to do lines of credit. It gave me a certain amount of economic sophistication to when you started teaching me, by the way, if you're a new business owner, the hardest thing I've had to learn in business is what Marcus taught me. I'm not stupid, but I could not put together conceptually the cash flow sheet, the balance sheet, and the P&L. It was one of the hardest things that hurt my brain to understand because I'd flip a bunch of houses and I'd be like, Marcus, I'm rich. And you'd be like, no, you're not. You're liquid. I'm like, what do you mean? My bank account says this. He's like, Jimmy, you're just liquid. You borrowed a bunch of money and flipped a house. And by the way, you need to buy more houses because you're just liquid right now. You're not rich. And so I want to say that was an 18-month period that you grinded me through.
Yeah, and it's not fun, right? And I think we talk about that and kind of this, you say it's backwards, but the one thing that you did that is forwards in a lot of ways was that you did get to a spot where you're like, okay, I feel like I need some liquidity here. And it was kudos to you. I didn't do anything other than say the right thing to you at the right time. I believe it was probably back in 2021 when I spoke at CG and I said from stage, hey, if you don't have $1 million in liquidity, you're going to have a problem over the next 5 years. And I think that opened up a lot of people's eyes, but I also think that was, you're an action taker.
Can I tell 2 more stories?
Yeah.
So this is just a day seared into my mind. March, it was St. Patty's Day, 2020, the day the world exploded because of COVID. Like, remember, it was like, hey, this China virus. Maybe it's a big deal. But then we were all at CG and they shut the NBA down. It's like, uh-oh, this is for real. And there was talk that Wall Street was going to shut down. If Wall Street shut down and they don't sell bonds, it means they can't sell mortgages, which means I have 40 turnkey rentals on my books right now that I can't unload. And I was like, all of us were like calling in lines of credit. We all thought the world was going to explode. It was the worst feeling ever. But then I was with Jason Lewis and he was chilling. And it's because I don't want to talk about Jason's pocketbook, but Jason had a ton of liquidity. And I'm like, why aren't you freaking out? He's like, because I'm liquid. I was like, oh, I got to get liquid. And then I went on a liquidity journey through 20, 21, 22, and then the back half of 22, you gave at CG, when interest rates exploded, you gave the same talk. Like, you got to have $1.5 million in your business. And then that was just like, I was just driven to get that liquidity as I was to get a Ranger tab. I'll say that. Like, I woke up and ate, bled, thought liquidity.
And I'll attest to that. I've never seen somebody so focused on a goal. And I think that's how you kind of approached everything. I think that's maybe your superpower is you do a lot, but you focus on what you're doing at one time. I think that's one thing that you don't multitask. I don't think that's what you're actually doing. You're very, very good at switch tasking, I think is the term for it, where, hey, I can dial in my focus here, but then I can shell that away and I can go focus on this now. And then I can focus on this now. And I think that's what you've been really successful at. And, that cash management is certainly a piece of it. So one of the things now that we've kind of, we've gotten to a spot where you've gotten liquidity, you're making decent money, unfortunately in the high tax brackets that we see for the high earners in this country. And you and I have a lot of conversation. How do we solve for that? Obviously, buying real estate is one of the pieces of the puzzle. So talk to me a little bit about how you look at buying real estate for your tax liability and how you feel like, I know this is such a big part of your business is buying and selling rental real estate to investors and obviously keeping some yourself. So let's talk through that.
Yep. Can we tell one more story?
Yes.
And it has to do with you and CG. I didn't understand the tax code. I didn't understand how anything worked, but I was flipping a bunch of houses. And I thought when you rehabbed a house, that was a deduction. You explained to me it was a CapEx. But the first year I did like 100 flips, I thought I didn't understand how taxes work. So I would take my profits from my flips, save no money for taxes, and reinvest it into a flip. And so I think I got punched in the face twice early in 2020. And one was when I got a $250,000 tax bill and I looked at my bank account and I had like 70 grand. And luckily, bonus depreciation existed then. And then you gave a talk on bonus depreciation, buying rentals. And then I hadn't cost segged. I hadn't done any bonus depreciation on all the houses I bought. That's what's so exciting about this time right now is the Trump tax cuts, the bonus depreciation thing was, do you think it was an experiment then? Like people were like, is this real?
Well, people didn't understand. So it's funny when we go back. So I was looking at, we were doing cost segregation studies back in the 2000 teens, right? In the 2016, 15, 14, when we just started, but we did it a lot on multifamily. And at that time, it was around 50% bonus depreciation. So it was still not bad. But in the single family space, there was not an opportunity because the cost versus benefit wasn't there. Well, as time improved, what happened was 100% bonus depreciation came out with the first round of Tax Cuts and Jobs Act. So you hit the nail on the head. That was, I'll never forget this. It was September 2017 was the effective date of that 100% bonus depreciation. So and I actually think it was like September 19th of 2017. There was a specific date, and anything you bought after that, you could get 100% bonus depreciation on. But there was still a problem. And that problem was that you couldn't go spend $5,000 on a cost segregation for a single family house. It just still didn't make sense, even at 100% bonus depreciation. And then somebody figured it out. They figured out how to do a cost segregation for single family homes at a price that is affordable. And we see them anywhere from $400 to $700 or $1,000 potentially.
Well, and you could do them yourself now, and AI can do them now. But that had to go to the Supreme Court, right? Like the fact to make it economical for single family, there were a couple court cases, right?
Right. So, different, and I won't get into the specifics as far as the terminology, but just from a 30,000 foot view, basically when you get an apartment complex done, and let's say you get a $5,000 or $10,000 cost segregation study, which, by the way, let's talk about what a cost segregation study is for those that don't know. Cost segregation study is simply an engineering study that on a piece of real estate that separates all of the parts of the real estate. So when you buy a house, you don't just buy a building. You buy a building, and that building has floors in it. And that building has ceiling fans in it. And that building has all of these different fixtures that the IRS tax code allows you to depreciate at a much lower rate. 100% bonus depreciation is what we're talking about here. And so just a side note on what that cost segregation is. But if you're buying a $5,000 and $10,000 cost segregation, the reason why you're doing that is because engineers are coming out to the spot and they are looking at every nook and cranny of that facility. And the bigger the facility, you have to do that. But for single family, they were able to create basically an estimator, if you will, that, hey, if I were to send a engineer out there, they would be around this amount. And the IRS has approved that methodology of estimating for these types of assets, and it allows it to be super efficient from a cost perspective. But it also, the good thing is a lot of these companies will back it with an audit. And so if you get audited, then they'll send an engineer out there to do a full study at no cost just to back up their work. And so, it's a really, really nice thing for single family homes. So going back to Jimmy's story of 2022, big tax bill, we're like, hey, we can do this cost segregation bonus depreciation thing, and we can really solve some of this problem.
Like you wiped it out. So I went from completely terrified to, oh, good, I'm not going out of business this week.
Right. And you're right. You hit the nail on the head because most people didn't even know it was a thing. It started in 2017 and you're talking about 2022. You're like, is this even legal? Am I going to go to jail for doing this? And that was a sediment. And then by 2024, it goes down to 80% already. So by the time people actually kind of started figuring it out and how to use it and what the returns were on it, it was gone. Now it's back.
And that's why I think everybody's so excited, because it's like, okay, we didn't know exactly what we were doing the first time, but now we know, and it's game on.
Totally. And if you do this the right way, and I think this is what's important here, I think, as far as doing it for tax purposes. There's a ton of reason to buy real estate, right? And we appreciation, depreciation, principal pay down, maybe even a little cash flow if you get lucky, right? So there's plenty of reasons to buy real estate. But when you are in the high tax brackets and when you're paying 40%, 45%, and on every dollar you make, you're in essence, a lot of times, getting paid in this market with 100% bonus depreciation to buy real estate. Because of your tax liability going down, it will, in a lot of times, cover nearly your entire down payment from your tax liability to buy that piece of real estate. And that mathematical problem there is what's so exciting to me. That's what's so exciting to Jimmy. I know that's like when he heard this 100% bonus depreciation was back, he's like, hey, how's the math? How do I do it? I want to see it on every single property so that when I'm making decisions on whether to buy or sell, I'm running it through this formula.
Yep.
So let's talk about the real estate that you're buying right now. What type? You're not just buying any real estate. That just, obviously we don't just buy to buy. We can't just buy junk. Talk about the type of real estate that you're buying. What real estate do you believe in today's market?
180 to $225,000 3-bed, 2-bath rentals.
Okay. Why?
Going back to starting backwards, like I started in C-class assets. And when you're starting, I think it's great to start in C-class. I even started in some D-class assets. And your play is cash flow. But what I've seen with these C-class assets is the median home price in the United States since the Battle of Midway in World War II has appreciated at 5%. I'm not seeing that appreciation with the C-class assets. The appreciation I'm seeing in the Midwest, and we operate in Wichita, St. Louis, and Little Rock, the appreciation that I see is these neighborhoods that are half rentals, half still homeowners. And so the reason you see the appreciation is you can hold it as a rental for a few years and then go in, do a real rehab, and then sell it to a retail buyer who's going to pay the highest. And when you buy a C-class asset, you're always going to be trying to sell it to another investor who wants the house at a discount.
So what I'm hearing you say is with a C-class asset, yes, you might reap some benefits on the cash flow from a month-to-month standpoint. Like, hey, my mortgage is, $700 a month. I'm renting it out for $1,200 a month. Maybe I'm cash flowing a few hundred there. But when you actually look at it from the long term, it's like, okay, well, it turns. Well, now I've got to put a new renter in there. That's more expensive on a C-class property than it is A or B. Just the tenant is better on an A or B class property. But then the other thing that you're saying is, well, these properties aren't even appreciating because I don't have comps for a retail buyer because the only buyer in the neighborhood is an investor. And we know investors don't pay the top dollar. Retail buyers do. So your strategy is to buy assets where for the foreseeable future, you're going to have retail comps that are continuing to push the market in the area.
Yeah, and then I'm also buying in the Midwest where the markets are exceptionally mediocre. Like, they're not going to be in like an Austin, Texas. They're not going to appreciate like California and Arizona, but they're also not going to have a crash. Like these markets, I've done the math on this. The markets I've talked about, even in 2008, St. Louis, the median home price went down 9%. Like it was a blip in the Midwest.
And these houses that you're generally trying to buy or secure for 180 to 220, where are you wanting to see rents at on those types of properties?
1,700. The other thing I started, like everybody was like, we're investing for cap rate and cash flow. No, cash flow and cap rate is a permission slip to buy the asset for the first 24 months. And like when I realized in 2020, well, you don't want to feed the meter every month. You don't want to be cash flow negative every month. But I saw people buy bad assets that they're not going to love for 10 years where you need to hold real estate for about that long because they sold out for the year one cash flow. It's like stepping over dollars to chase pennies. And then the other thing is, my clientele are high income earning salespeople, business people, doctors, lawyers, real estate investors in the coastal markets. And it's like they all start to call, not so much the real estate people, but most of the high earning salespeople. They're like, I want cash flow. These are people making $500,000-$600,000 a year. I'm like, why? You don't have a cash flow issue. You make plenty of money. You have a wealth preservation issue and you have a tax issue. I can help you with both. And yeah, 10 years from now, these will cash flow and you will build a ton of equity, which you can turn into cash flow. But like, why would you win four ways in real estate: appreciation, the ability to use leverage, tax advantages, and finally cash flow. Buying an asset off its year one cash flow is asinine. And that's how I ran my business the first 5 years.
Do you want to know the secret to making every piece of real estate cash flow?
Owning it long enough?
No debt. You want to cash flow that piece of real estate? Don't put debt on it. But that's the whole thing. And this is what I think about real estate.
And hey, if we were on a gold standard, I'd probably do that.
Well, and I'm not necessarily a proponent of no debt. So my belief around debt is that bad debt is any debt that doesn't pay for itself. So rental debt would be considered good debt in my book. However, if your goal is to cash flow, let's say you're that doctor, you're that real estate professional, you're that high income earner. Like, I'm consistently making money year over year. This is like my bottom dollar. Like, a bad year is going to be 600 grand. Maybe I'm making a couple million in a good year. And you can start really stacking wealth that way. Cash flow is not the issue. If you want cash flow, that might be an issue later. You can pay off these rentals later. The rents are going to go up later. The principal is going to go down later. So eventually, that's, I think, what Jimmy's saying here. Eventually, these things are going to cash flow. But I think you're missing out if you're just trying to buy for cash flow today. And by the way, I don't know. I don't see a future anywhere in the near future, and I would say within 5 years, that we're going to see that 1% rule that we all used to know and love in the rental market.
Since 2022, I have been praising interest rates going up. I think it's been great for the market. I think it's been great for investors because it's got their eyes off cash flow. And now they're looking at it as a sophisticated investor saying, hey, I'm only buying this if I benefit all four ways. Like, if you're just buying real estate for year one tax savings, I mean, how many people do you see get hosed on 1031s?
Well, I mean, anytime you do anything for just tax purposes, it's a bad idea, right? So buying real estate is just that exact thing. Now, there's not an easier way. I'll tell you, as a tax strategist and somebody that saves millions of dollars a year for people in taxes, buying real estate and being a real estate professional and doing bonus depreciation and cost segregation and all these things and stacking this all together is the easiest way to reduce your tax liability. It is by far the easiest way to do it. And in my opinion, it gives you the most upside, right? Because you've got wealth building in there. And, that's why I love it. That's why I wanted to have this podcast, because the other thing that we're talking about and with a lot of our clients, what we do is we go through this process where it's like, okay, we've got to get your entity structure right. That's where a lot of your tax savings comes from, is just making sure the money's going to the right places. And then the second thing is like, hey, there's some like business, we call them entrepreneur strategies that the IRS gives you just because you're a business owner. And so you might as well take them. And so we make sure we get those done. But then the last one is like, okay, now these people they're the high income earners. These are the people that are kind of in this last bucket, which we call investment or wealth building tax strategies. And those are all about deploying capital to get a wealth return and a tax return at the same time. And so as Jimmy and I started talking, I was like, listen, I have so many clients that they need to buy real estate, and we're talking about buying real estate, but their problem is they can't make the numbers work in their market, not from a cash flow standpoint, just period. They just don't believe in their market from a rental perspective. And they don't want to buy junk. They don't want to go buy slumlord properties. They want decent assets. And I'm like, what can you do? And not from a perspective of like buying one or two, because that doesn't do anybody any good, but like, how do we form something that buys 10 or 15, 20 properties in an area so that these investors that are real estate professionals can go in and execute their business and then still know that there's real estate being bought on their behalf in the background, that they're not having to do all the work and pick off, here's my favorite thing with a real estate investor. Hey, I've got this sweet $50,000 profit deal, but I'm going to put it in my real estate portfolio and I'm not going to get any of the profit. I'm going to just put it in my real estate and we're going to call it a BRRRR strategy, but really you just locked up $50,000 worth of equity that you're not going to get access to, right? And so and it's a property that you didn't even like. That's the other thing that's a kicker on that. Like you got a $50,000 worth of equity in a junk property that you don't like. So by solving this problem, I think that's something that you've started to put your head towards, and I want to talk a little bit more about how you're attacking that and how you see potentially investors coming in and utilizing this strategy to help reduce their tax liability and build wealth at the same time.
Yep.
So what's that model? It's not turnkey. You don't like turnkey. I already got in trouble for calling it turnkey. What do you like to call it?
Yeah, let's define turnkey. So turnkey back in the day, and that's what we started in, was I would buy the house, I would fix the house, I would sell the house fully fixed, fully tenanted. And I'd pay about 7 to 10% of the deal went to transactions costs. Because we got 2 purchases, we got I had to hold the house, I had to pay all the closing costs, I had to do all that type of stuff. And I was like, wait a minute. I don't love doing this. And I work with high net wealthy people. What would they save if they just bought it from me cash? And I was like, oh, well, there's about 7% there. And then when we got good at wholesaling, I'm like, wait a minute. I'm getting houses at really deep discounts. And I'm like, why am I doing turnkey when everybody really wants a Berkey? And then after selling to other real estate professionals, people in the game, my ego will not allow me to pay retail for a house. So as a real estate professional, they want to have a discount on a house. So it's like, cool. Our system is we sell the houses at a 15% discount, and we do a BRRRR deal. So the person buys the house cash. We find the house for them. We give you all the inspection updates. Then we build the scope of work for you, and then we manage the construction for you. After we then find the resident for you, you go refi the house. It's the basic BRRRR deal everybody starts with that everybody on Bigger Pockets is chasing.
And so when you go out, I mean, it just sounds so simple.
I'm a simple man. It's like, I don't understand why more wholesalers don't do this. It's just like, everybody focused on the seller, where we've always focused on the buyer.
Right. Well, and you make it sound so simple for the buyer, but I happen to know it's very difficult for you guys. And when I say very difficult for you guys, there's a big piece of this that like every stage has to work. You have to buy the property at the right discount. You have to do the right scope of work. You have to have the right contractors. You have to, you have to have the right management in place, right? You got to get the right tenant in place. So you make it sound so easy from the investor standpoint, but like the hands-on piece of it is like, it's almost a nightmare.
But we're getting up to like our 1500th deal. So it's like we've made every mistake and fixed the process on every mistake going back to 2018.
And I think that's the other thing that as I was, kind of trying to think through this, investment tax strategy for our clients, one of the things that I liked about it the most was that they don't have to worry about managing it. They don't have to get a management company in place. By the way, the management company that they're going to put in place is managing their own rentals to the tune of several hundred rentals, right? And so you've got a fairly large management company in place with systems and processes that, if you're somebody that's a real estate professional, maybe you haven't bought a lot of real estate yet. And if you followed me at all, I don't recommend you do what Jimmy did, which was start buying a bunch of real estate. It worked out for him, but like a lot of people go broke that way. And so for a lot of those real estate investors, it's like, hey, I haven't bought a bunch of real estate yet. Now I need to, actually buy some real estate. This is a way you can do it, in my opinion, without having to deal with, I got to create my own property management company? Do I have to go, do I got to take away from the deals that I'm doing in my business that I'm marketing to? How does that play with my cash flow within the business? Like completely changes everything versus taking your profits and then reinvesting it.
That real estate entrepreneur you're talking about, that is like needs tax breaks because they're doing successfully and they're crushing it and really need to keep their eye on the ball. They're all like, how do I start a property management business, Jimmy? And I'm like, do not do that. keep your eye on the ball, hire that out until you have 300 rentals. Like I did everything backwards. I did property management because I had to, and I didn't know what else I was doing. And so I kind of got lucky.
Well, and I think, I had Mark De La Torre on there, good friend of both of ours, on the podcast recently. And he's talked about, for him, he did it the other way, right? He bought 300 rentals or had 300 rentals under a management company. And then that's when he started his management company, and it started day one cash flow positive. Right. And so I think that's a really good model. I don't know a lot of people that are buying real estate in that bulk right now. Unless it's a hedge fund or something like that. I think that has kind of subsided a lot, but that's why I think that 10 to 15 on an annual basis to be able to, stack a property a month, for some of you guys out there that, you're consistently making good money. And if you can kind of average that over the next 36 months or so, you could probably sign your retirement check.
Yeah, pretty much. And then, Mark's business started because after the crash, he was selling to overseas buyers, so he had to manage. I was selling 2018, 2019, where turnkey was a buzzword and pretty hot, so I had to manage it. Like, turnkey market's dead, so you're not going to have a big, market to manage for people either.
Well, I think if somebody is going to build a portfolio, and let's just say, all right, well, that sounds great. Maybe I can work with Jimmy. Maybe I can not work with Jimmy. But I think no matter what, if you're somebody that is in real estate or listening to this, you're at least interested in real estate, you should be thinking about buying real estate at some point in your journey. That is your exit. That is your retirement card. And so, Jimmy, talk about how important that is, that you don't just run down this track and forget about why you're on the track in the first place. Because, man, I've dealt with so many people that they've been in this for a decade and they don't have any good they may have real estate, but it's those flips that went bad that they had to refinance into their own portfolio. None of them have, a decade in and they've got junk real estate and they haven't actually built any wealth. So talk to that investor of like how important this is to focus on buying real estate, no matter if it's from you or anybody.
Yeah. I mean, I call my bad flips my kids' problem because I turn them into rentals and I'm just like, oh, they're going to inherit those. But they'll be able to flip it and make a ton of money.
Time does heal all deals usually.
Real estate's like a bad haircut. Time will solve every problem. So, I mean, owning rentals and building it over time has done great things for me just from simply being able to pull lines of credit off them. Like once I owned all of them for 5 years, I did a huge line of credit and that's what I flip with now. But the banks also love it that you have assets. So there's also benefits there. And then you don't want to get done flipping or wholesaling a ton of houses every year and only have cash to show for it. Cash is awesome. Liquidity is awesome. You got to but you want all of it. This is America, Marcus. You want it all.
Yeah, you should have it all.
Cash is a big deal. And I agree with you. Order of operations, it's successful business. Then it's extracting cash from your business. But then once you have so much cash and you hit your liquidity goals, now it's time to start planning for the future. And if you read any of Ray Dalio's stuff, the two greatest threats to anyone's wealth is taxes and inflation. And so these houses are just beautiful inflation hedges.
Why? Why is a house an inflation hedge?
Because it's going to appreciate 5% a year. And I have pretty compelling data that the median home price in the United States appreciates at 5% a year. So here's the fun part. Here's what I love about my rental portfolio. I buy them with somewhat garbage $20-$25. I'm comparing dollars in 2005 when I started this. And so some of the rentals I still have from 2005, they're going to be paid off in 10 years. And I'm going to give the bank back garbage dollars compared to the 2005 dollars. If you buy a 2020 house in 2025, when you want to refi or sell in 2035, you're paying the bank back with garbage dollars, which is very funny to me because I kind of like working systems and rigging systems, but the system's been built for you. Like the dollar is not going to go up in value. It would create so much austerity there would be a communist revolt throughout North America. So cool. We accept what it is. The dollar's going to lose value and keep losing value. Maybe crypto will gain value. We don't know. But can I give a quick history lesson to your listeners?
Please.
And I took this playbook straight up from the founding fathers. I'm kind of a history nerd, and I had a ton of time to read when I was overseas. But do you know what the continental dollar was?
No. Talk about it.
So we beat the British with a hyperinflated currency. You know, we had to beat the greatest army on earth at the time, and we had no money. So guess what the founding fathers did? They just made some up. They just printed it, right? And it went to zero. But here was the trade they made in the 7 years of the revolution. They got these garbage dollars called continentals, and they bought land and they bought real estate with the garbage dollars, right? And when the currency collapsed, what happened to the real estate?
They still had it.
They still had it. Same thing happened in the Civil War. The Confederate currency went to zero, but it was the first time we went to private money. And so everybody was rich. The Vanderbilts, you can read this. The playbook's already been set. The Vanderbilts, other rich people back then, they took this hyperinflated currency and they bought hard assets with it. And then when the currency collapsed, their hard assets were worth a bunch in the new currency. And so I think it's going to be a slow burn, but the same thing's happening. And so even if you buy 10 a year, 5 a year, you got to place that trade. That's why real estate's created so much wealth in this country. So it's kind of a pessimistic thing. I'm saying yes, currency always collapsed in North America. It's been doing it for 400 years. But the people who get wealthy are the people who hold assets.
Well, I mean, it's hard to argue with history, but also, like, if you look at it, there's already currencies being created to solve for the currency that is declining. Like, it's already, like, it's almost in front of us, right? In crypto, right? They're literally trying to make currencies because of this. And, you know, we'll see how it goes, to your point, but here's the reality. And I think this is what you're trying to get at here. If there is a time where you have to trade something for something other than a dollar, that real estate is going to trade. It will be valuable in whatever way whatever currency is traded. And even if the dollar continues to devalue and is never changed out, and we're not ever using another currency, it's still going to improve your wealth because of that declining dollar value and how you're paying with future dollars on today's asset.
And the best part is the people creating the problem, the people printing the money, are also lending you the money to buy the houses. It's magical. So I don't think it's a huge wealth driver. It's not going to take your business to the next level, but this is a hedge you got to be throwing out there. And then the fact that it also saves you in taxes, it's like this country was created by real estate investors for real estate investors. And I think you get frustrated that real estate investors don't take advantage of everything.
Yeah, well, here's the deal. Buying real estate is a wealth savings account. That's what it is. It's a wealth savings account. It will absolutely over time increase your wealth over time, right? And so many times you don't, how many of us are stacking away that $1,000 into our savings account? I can tell you not very many of us, because I see the books, right? And so this is like a forced savings account where, hey, you buy it, don't worry about the cash flow, don't worry about anything, just like set it, put a few bucks into an account just in case there's some drawdown, and then wake up in 10 years and figure out where you're at. And you probably have a house that's worth a lot more money. You're probably at 50% loan to value because of the principal pay down and the price increase at a minimum. You get liquidity available there. So no matter what you do, once you get to a spot in real estate, don't forget to buy real estate. Don't forget to buy real estate. Jimmy, if they want to get a hold of you and they want to buy real estate from you, how would they do that?
Just go to Instagram and DM me, Jimmy Vreeland, V as in Victor, REELAND, or go to jimmyvreeland.com.
Yep.
The next objection in probably everybody's mind, why not a syndication? And then I'm going to counter. The real estate investors I see investing in syndications don't exactly love it because they never have control. They don't get control when they sell. They don't get control when they get their cash back. I would just say the lack of control is what's bothering everybody right now.
Yeah, 100%, right? I think, I think there's a spot for syndications, just like there's a spot for anything. I think with the right operator and the right knowing what you're getting into, I think there's an opportunity there. But man, I also see that there's a huge opportunity in owning your own real estate, right? Like you decide when you exit, and on that exit, you decide if you want to do a 1031 exchange. And by the way, like maybe you're somebody that's in Florida and you're like, man, I don't want to buy a bunch of St. Louis real estate and hold on to that for 30 years. Guess what? Maybe you just have to hold on to it for 10. You sell it all back to Jimmy in a package because he loves having real estate in that area. And you go 1031 it into something in Florida, right? You could do that. Right? If you don't want to have St. Louis real estate or Little Rock real estate or Wichita real estate. So there's all kinds of options here. Jimmy, one of the last things I like to leave people with, one of my favorite sayings is better decisions, better results. If you become a better decision maker, you're automatically going to get better results. It's just a matter of time. Knowing what you know about real estate business, everything you've been through, what can you give them to help them make better decisions today so that they can go get better results?
I would say the reason I save money in taxes is because I have a tax plan that I didn't necessarily create, that generally you created, but we don't start talking about taxes in October. We start talking about, what we're currently executing, we started talking about 2 years ago. And so whether it's an operating agreement, whether it's any business transaction, I like to lay out the planning. We did this in the military all the time. You don't start making a plan when the bullets are flying. You start planning while you're training, and you do it well before things are emotional. So if you want to start making better decisions, better tax decisions, recognize it's going to be like a 15 to 18 month process. And then once you've made that decision, monitor its results, do after action reviews, get better. Anything you didn't like, then fix, and then carry on.
Yeah, I think that's great. And everything that they do. I don't think you should do anything without a plan. I don't think you should start your day without a plan. It's one of those things that I think everything done with a plan gets executed at a more crisp level. And I think you're a fine example of that through everything that you've achieved so far. Jimmy, I appreciate you joining Strength in Numbers. It's been fun. I can't wait to jump on and talk again, and we'll look forward to doing it soon.
Thanks, Marcus. I appreciate you having me on.
Thanks, Jimmy.
So if you like what you heard today and you want to learn more, sign up for a discovery call with one of the Vreeland Capital success coaches at jimmyvreeland.com.